Hi there, I'm Irk, and this is my channel, Get Irked. In this episode, what should long-term investors do when everyone panics and the market sells off? Before I get started, I wanted to recognize the fact that Russia's invasion of Ukraine is absolutely inexcusable, and my heart goes out to all of the Ukrainians who are having to defend their freedom against an invading force. When looking at the stock market, it's important to remember the humanity that's going on behind the scenes. The stock market has no soul and has no emotions. It doesn't care what's going on. It's just going to react. As investors, we're still human, and it's important for us to keep our emotions and pay attention to the fact that there are people who are being hurt and killed by the events that are going on the geopolitical stage. However, my goal with Get Irked is to teach everyone how to be able to handle market-wide sell-offs. So we're going to ignore the reasons for why it's selling off, and we're going to talk more about what the strategies and techniques are to protect yourself from a sell-off. I did want to acknowledge the fact that I am in no way a professional advisor. These are just the strategies I use for my own investments. You should probably consult with a professional and not some crazy guy on YouTube when it comes to managing your own investments. Also, my strategies are for long-term investors, not for day traders or traders of any kind. So if you are a trader, you'll probably want to hit the road because my strategies are going to be in conflict with what you think anyone should do when it comes to the market. For long-term investors, a market-wide sell-off presents a buying opportunity because it means that your stocks and ETFs are selling off across the board. Because it's a market-wide sell-off, it's likely that there is no company-specific or sector-specific news that's affecting your positions. Everything is selling off. To look on the bright side, it means that you can stock up on your existing positions by buying them at lower levels. I'm a huge proponent of buying in stages. In other words, I don't buy my full investment all at once. I buy about 50% at most, and then I save the remaining 50% to buy in stages on the way down if the asset sells off. If the asset never sells off, then what I have is what I have, and I'll take that 50% and apply it to a different investment sometime in the future. Long-term investors are those who have an investment horizon of 5 years at the minimum. For me, I have an investment horizon of anywhere from 20 to 30 years. This means that it's not a matter of if I'm going to see a stock market sell-off of a dramatic kind, it's when. In fact, we've seen two major sell-offs in just the past 3.5 years. The first being in 2018, where the S&P 500 sold off 20% from its highs in October to its lows in December. And of course, the pandemic sell-off in March of 2020, where the S&P 500 sold off more than 30% in a month. New investors might think this kind of price action is unusual, but it's not. Even before 2018, we saw a huge sell-off in 2012, another one in 2008, another one in 2001, another one in 2003. It goes on and on. So instead of being afraid of market-wide sell-offs, it's important to have a plan for them in advance. You need to figure out what are you going to do when the market will sell off, not if the market will sell off. When I say plan in advance, I mean you look at the stock or the ETF that you want to buy, you take a look at its price action in the past, and you determine levels where it might be able to find support. In this example, I'm going to use Block with the ticker symbol SQ, and this is one of my long-term favorites, with many of my viewers knowing exactly where I'm going to go with this one. I use a variety of different strategies in order to determine price levels in the past, but it's as easy as just looking at a chart and seeing where there was a lot of price action. And you can see, for example, here we've got a ton of price action around $118. We have more price action down here around $98.93, and even more price action down here around $84.79. So you can use these levels to be able to determine where you might want to put in buys. In my experience, I've noticed that even professional traders seem to want to be able to make the decision when they're going to make their buy, and that's not how I operate. In order to remove emotion from what I'm doing, I like to put my orders in advance, and I always use limit orders. A limit order means that your broker will not process the order unless you get your price or better. And in many cases, I'll get much better prices than the ones that I put in because something will happen that causes the stock to open at a lower price, and that's where I'll get filled. Traders will think this kind of approach lacks discipline because they want to be in full control of their asset. But you have to remember, when you've got a really long time horizon, you're just trying to get the best possible price when you buy buy a stock, but you're planning to hold it for a very, very long time. This means that if your investment decreases in value after you buy it, that's okay. Now, traders out there are going to freak out at the very fact that I said that, and that's what makes them a trader. They want to make money, so their position has to increase in value quickly. But if you're a long-term investor, you should only be buying the assets that you have faith in over the long term, and that's whether you're talking about an ETF, stocks, or cryptocurrency. You should never buy something that you're skeptical of or you don't believe that the management's going to succeed. If you have any doubts that the company or asset you're buying is not going to be here in 5 or 10 years or 20 years, why are you even buying it? As a long-term investor, you need to have a thesis behind why you're buying what it is, and that thesis needs to be a heck of a lot more than numbers go up, I think I'm going to make a profit. For me, when it comes to Block, I had a number of buy targets I wanted. I've done an in-depth video on Block if you want to learn more, but we're only going to cover the trades that I've done since the beginning of February 2022 in this particular example. I made my first February buy in Block on February 7th at $102.65, and if you look in the past, you can see exactly why I did this, because there's a lot of price support back here, and I thought it might find support again. A little over a week later, I made my second buy in February on the 23rd at $92.85, and if you look in the past, you can see, again, there's price action in the past, which is what dictated that price level for me. From there, I decided that my next price target was going to be around $84 or so, because I wanted to get in a little bit early, and I was looking at these two spots here for support, $84.06, so that was my limit order. However, on the next day, Russia invaded Ukraine, and the entire US stock market started down by a series of multiples. The result was that Block opened below my $84 limit order, so I actually got filled at $83 on a day where the low for Block was $82.72, so I missed the bottom by 28 cents, and the only reason I'm able to do that consistently is through the use of limit orders. If we switch to the 1 minute time frame, you can see that Block only touched that low for a brief period of time, not even more than a couple of minutes, where it was above $83, so I actually got the best possible price. I never trade in the after hours. I always wait for the market open, so I would never have been able to get that price unless I had that limit order in advance. And again, the important thing to remember is I never buy all at once. I still have additional funds, and a lot of them for use at lower levels if Block sells off from here. However, a lower price never happened. Block had to report earnings Thursday evening. They blew away expectations and jumped more than 20% in the next day. Because of this, over that 2-day time frame, I made more than 40% in one day. Even when you calculate in the orders that I had made before, I made more than 30% above my average buying price. And the only reason I was able to do that was by buying small quantities in stages over time. This strategy does require patience on the part of the investor, and you have to keep reminding yourself that you're in this for the long term. You should never make a short-term decision about a long-term investment. I always say that there are two different actions you can take on any day when it comes to the stock market, and many new investors will make the mistake of thinking those two actions are buy or sell. But that's not the case. I have a rule. You can only buy on red days and you can only sell on green days. So what's the other action? On a red day, you can take one of two approaches. You can either buy or you can hold. And on a green day, you can only take two actions. You can sell or you can hold. One of the most important things to remember, whether you're an investor or a trader, is that taking no action at all is in itself an action. In fact, a couple of my favorite adages about this are, if you don't know what to do, do nothing at all, or don't just stand there, do nothing. It's best to kind of think of it the same way you think about poker. When it comes to poker, you can call, you can raise, or you can hold. In the stock market, you can buy, you can sell, or you can hold. The reason why I always wait for a green day to make a sale is that I want to avoid panic selling. I don't want to get emotional and sell into a market sell-off because everyone else is selling. You can picture the stock market kind of like Wile E. Coyote running off a cliff and falling to his doom. Now, in the real world, they're going to die when they hit the bottom, but I've got a secret for you. The stock market always has a trampoline under it. The big question is that no one knows how far down that trampoline trampoline is. So sure, you could sell all your stocks and grab onto the cliff and hope that you're going to be able to get back on before the trampoline rises above you, but without knowing where that point is, chances are you're going to miss it. Even the best professional traders will tell you that no one can time the markets. You have no idea where the bottom is and you have no idea where the top is. The trick is not to find the bottom or the top. The trick is to think of it as a sandwich. You want to be able to capitalize on everything that's in the middle. That's where you're going to make the most money. If you don't get in at the bottom, that's fine. You can still capitalize on most of it. And if you get out before the top, that's also fine as long as you're taking gains. Another one of my orders that filled during the Russian invasion was in Logitech. I had looked at the past and I had seen that this drop down here at $71.11, which happened in January, was going to be my next price target. However, on the day of the invasion, Logitech ended up selling down to $69.92. And my limit order, which was at $71.80, got filled at $70, missing the bottom by only 8 cents. Just like with Square, you can see that Logitech didn't stay at this bottom for more than a minute. In fact, after 3 minutes, it had already made it back up to $70.53. In fact, after just a few minutes, it had already bounced over $70. So because I used a limit order on the open, I got filled at a much better price than I intended. Once again, it would never have filled above the $71.80 that I had wanted. It would only fill at that price or better. In this case, I made $1.80, which multiplied by the number of shares in the order leads to real savings. A great example of why I always buy in stages and I never buy all at once is Tesla. I wanted to add to my Tesla position around $800, so on February 22nd, when it sold off, I made a buy at $815.80, which looked great until you see what happens over the next couple of days. Tesla ended up making a low down here at $700, a difference of $115.80 from where I made my initial buy, and that would have really stung had I not bought in stages. I made a second buy on the 24th of February during that sell-off at $717.22, which gave me an average buying price of the two orders of $766.51. And on the next day, the 25th, Tesla ended up closing the day at $809.87. And even though that was lower than my first buy at $815.80, because I bought in stages, I finished up 5.66% above my average buy price. Now, is it possible that Tesla can sell off again? Yes, in fact, it's almost likely. This is one of the most volatile stocks in the entire market, but that's why you need to buy in stages so you can capitalize on lower levels. Had I gone all in at $816, I would have had no funds available to buy in when it went even lower. Zero but zero. Doggo. Doggo. What am I doing?
Do you like stocks? Are you a stock dog? Are you a dog of stocks? I like the dog market.
No, stock market.
Dog market. I like the dog market.
He looks like me, doesn't he? Since starting my YouTube channel, I've noticed a lot of comments from people who say, wow, it must feel really good being a bag holder when a stock sells off. It's important to remember as a long-term investor that your asset will likely sell off, and a sell-off in your stock, as long as it doesn't upset your thesis, is a buying opportunity, not something you should feel bad about. These commenters who give you a hard time for being down aren't going to be there in 5 or 10 years when you're up 20x, and a perfect example of that is Block. I opened my position in Block in 2016 at $11 and it went up to $289, more than 20x, and I took profits the entire time. Another term I hear overused far too much is the idea of opportunity cost. This sounds good in principle. It's the concept that you're putting money into an asset and it's sold off and that money might be better served in a different investment. However, the people who throw this term around forget that it only works with 20/20 hindsight. At the time, you have no idea what's going to be a good investment and what isn't. For example, when I bought Apple in 2013, a lot of people thought that it was down for the count. Apple's currently trading over $150, and when I bought it, it was $14. So how's that for opportunity cost? Or better said, how do you like them apples? As a long-term investor, it's important to remember you're going to see a lot of terrifying market-wide sell-offs, and every time they happen, they will feel different from the last time. In fact, I've noticed how funny it is that people will say, man, I'd really love to buy Tesla if it went down to $700, and then when it happens, they panic and they don't buy it. The reason a stock sells off dramatically will never feel good. Every market-wide sell-off feels different, and when it does happen, you'll feel like this is the end of the world. This is another reason I always put my limit orders in advance, because I don't want to be able to have the emotion distract me from making a purchase that will end up being a good thing in the long term. Here in 2022, we still don't know how far off this sell-off could go, but it's important to remember we're only down about 10%, so if you're looking at even the pandemic sell-off, 30% is a long way from here. As long as you're patient, you keep your head on straight, you don't panic, and you buy in stages, you will be able to invest for the long term and never really shake yourself out of the market. Please check out my website, getirk.com, for more free information. Hit like and subscribe, and I'll see you in the next video.